Good morning and good afternoon, ladies and gentlemen. Holy cow. If you could see my desk, you would know that it reflects what's going on in the world right now. Piles of things, a mess, maybe a few bright spots, and that's what we're going to talk about today. Allie and I welcome you today to the 38th COVID and HMU housing market update. So if we were a person, we would be Gen X. However, Allie made this point just before we started. We're dealing with as much uncertainty now as we did when we started in COVID. However, today we will try to decode some of that for you, and note that there'll be a recording afterwards, and please send your questions in because we pay attention. And I want to give a shout out to our friends at Triad. They are once again our sponsors. And Russ and Lowell, thank you for your support. We appreciate you guys so much. You can see on the slide what their skill sets are in wood and timber and steel stud and modular, but they help builders on the multifamily side, the single family side, and the whole goal is to increase production and bottom line results because they're quick. Notice they've been together for 60 continuous years. And in the labor market that we've got going on, Triad offers equipment for the wall framing, sheathing, wall panels, floor decks, subcomponent systems, stair manufacturing. If you're building it, Triad's probably going to help you do it. And their engineers have solutions so customers can save labor and reduce headcount. And I think even better than that, they're the fastest lead times in the industry. And they have a parts and service department that's second to none. So it's their own company, and they'll keep your production humming. And they're in their 7th continuous decade of helping builders and helping them make the American dream. So once again, Russ and Lowell and our friends at Triad, thank you, thank you, thank you. We appreciate it so much. Now, fasten your seatbelts because today, Allie and I are going to go probably 5 minutes long. And part of it has to do with a few of the advertisements I'm about to share with you, but really it has to do with the content. We've got a ton of content. I'll give you a hint about what Allie's going to talk about in a second, but bear with me here simply because we are, as an organization, here to help you. And my side of the house, the Zonda advisory side, we're deep in the single family built to rent side. We're pricing and repositioning so much right now because you're going to see in some of our data, homes are selling, but there's some adjustments being made. And we're doing some really interesting analysis on total addressable markets for the multifamily side, the build for rent side, even for some home builders looking at new markets. We've got a bunch of upcoming events. Please, if you're in the build for rent, single family or horizontal apartments, join us in Dallas the 27th and 28th. But also note, we've got Seattle Dealmakers coming up and Builder 100, which is the creme de la creme in the industry. We hope to see you there. And Enterprise, which is, that is that database that way back in the day, it was the combination of Myers and Metro Study. And it's now got master plan community profiles, the deep market reports, and it's integrated with all the data. But I want to make sure that you're aware that we now have market snapshots that you can get online and get one for free. And if you saw the recent information that we put out in Builder Pulse today, there's a quick snapshot of Chicago. It gives you some sense of what you can get for free. Really interesting stuff. It's the basis from what we do much of our market research. So check it out if you can. And also Zonda Virtual. This is a game changer because it's virtual reality. You can create interactive site plans. The thing I like most about it is the 3D home renderings, and it's really cost efficient. The whole goal here is that we're trying to help you sell more and sell more often. And one last thing to include, Livable. Now, they say the best things in life are free. Guess what? Livable is free. So it must be one of the best things in life. And it is a listing service. You can list anything and everything for sale, downtown, uptown, suburbs. Talk to Karen Bonder, my associate. She is a wizard. She understands this completely. But remember, it's a free listing service for the new home market. Okay, Allie, here we go. Now today, Allie and I will cover the 7 things you see here. She'll start with the first 3. I'll go into the next 4. And as I introduce Allie, I get a chance to introduce her a couple times a week. I always try to mix it up, and it's pretty easy with Allie because of how busy and how deep she is in the world right now. She's our chief economist. But one of the things I want you to know is if you're old enough to remember the Batman TV show and there was the bat phone, Well, I have the ATL, the Alley text line. Daily, we are trading information about what both of us are seeing. Now, she's deep in the President's Council of Economic Advisors. She's working with building product manufacturers. She's on presenting to boards of home builders. She just presented at South by Southwest on the future of housing with representatives from Oakwood and Icon and Fading West, talking about manufactured housing, 3D printing, modular. But here's what Allie's been digging into and what we're going to talk about today. You're going to hear about the Fed, what they're doing and maybe what they did. Inflation, the law of unintended consequences, interest rate shifts, how builders are responding, and what we want you to know. All is not lost. Unfortunately, it's not yet all found. With that, I turn it over to Allie to dive into this crazy world that we're experiencing now. Allie, if you would, take the virtual stage.
Awesome. Thank you, Tim. And hello, everyone. As Tim said, we have a lot to cover, so I'm going to dive straight into the economic backdrop. And where I thought it made most sense today was to acknowledge that 3 of the Federal Reserve's 5 general functions are in question today. Now, as we look at them, let's go back to some of the past presentations that we've done, where we talked about in the 1970s, Congress gave the Federal Reserve the dual mandate, promote maximum employment and price stability. We will talk about that in this section, but then of course, we also need to talk about some other general functions that we haven't focused on that much in the past. The idea that the Federal Reserve promotes the stability of the financial system and seeks to minimize and contain systemic risks. And very notably, they promote the safety and soundness of individual financial institutions and monitor their impact on the financial system as a whole. 2 and 3 are the big parts that have changed just over the past week. As I go through this section, I want to start with the economy leading up to SVB, Signature Bank, Silvergate. I want to talk about what we thought really up until last Friday, and then how things have evolved since. So let's start by looking at the jobs report that came out last Friday. It showed that the U.S. economy continues rolling. We now have 2% more employees than we did going into the pandemic. And it was a second stronger than expected jobs report. 500,000 jobs added in January, 310 added in February. Now, as we looked at the data, put yourself in the shoes of an economist who, for the past really 2 years, have been nervous about a wage price spiral. The idea that people are bringing in more wages and demanding higher wages because they're ultimately finding that their costs have gone up. And then companies raise their costs in response to paying employees more money, and it falls into this vicious cycle. Well, ultimately, what we're finding for the data in February was that average hourly earnings were up just 0.2% month over month. Lowest level since February of 2022. 1 month does not make a trend, but we're hoping that this is the end of some of those really heightened fears about how the market might evolve. Now, we also had other good news that came out of the report where the unemployment rate rose. Now, sounds counterintuitive to say, but we saw the unemployment rate move from 3.4% to 3.6%, mostly because 400,000 more job seekers entered the market. A huge constraint in the economy has been that the labor force participation rate has been below where we saw going into the pandemic. For the February data, we finally found that those in prime working years, between 25 and 54, are now actually slightly above where we were going into the pandemic. So we have some good news that came out of this jobs report, but put yourself now in the Fed's shoes. The Fed is trying to slow the economy. The Fed doesn't want to continue to see stronger than expected job growth. And so this report on the whole was saying to the Federal Reserve last week, keep pumping the brakes, keep raising short-term interest rates because the economy is still operating a bit too hot. Now, you have to look at this data source from the Bureau of Labor Statistics, but then say, well, what are we seeing from some private sources? The Fed's going to be looking at a lot of different sources, and just look at LinkedIn's latest hiring report. They saw the largest hiring decline in February since April of 2020. In fact, what they found is that year-over-year hiring is down 30% compared to last year and has now declined for 10 consecutive months. This is completely opposite of what we just talked about. And the Federal Reserve is trying to dissect all of this. I think what we have to think about is who are the constituents behind LinkedIn's usage. In a lot of cases, it's more of those white collar workers, whereas we've tracked over the past 6 months, more of the job losses have been more white collar versus the government source that tracks all of these different industries. So Federal Reserve is trying to put this together, and this private data is saying to the Federal Reserve, you know what? Actually, you can slow down on raising short-term interest rates because in real time, we're seeing the economy is slowing. So mixed messages on the maximum employment front. So then the Federal Reserve says, okay, well, let's look at price stability. What are we seeing from inflation? Two main ways to measure inflation: PCE, CPI. PCE, personal consumption expenditures. This is the Federal Reserve's preferred measure because what happens with PCE is when costs are going up, households are going to say, do I want to buy that? Or am I going to go to this more affordable alternative of this? PCE should be trending down, and yet 2 weeks ago, this report came out worse than expected, meaning more inflation on a month-over-month basis and more inflation on a year-over-year basis. So all eyes turned to yesterday's Consumer Price Index, CPI. This one now came in better than expected. Month-over-month, better than expected. Year-over-year, better than expected. So you can see why for the Federal Reserve, it's complicated. There are so many different data sources, none of them pointing in the right directional trend or telling you the same story. I think high level, we understand that inflation is past the point of peak from that year over year change, but we're still talking up between 5 and 6% compared to last year, when the target is an average of 2. And if you look at it by market, we just wrote a blog on Builder about this. Phoenix up almost 12% year over year. Atlanta, Tampa, Miami, inflation up 10% year over year. So it depends on the source that you're looking at for inflation, and also depends on how you cut the data. The numbers I just showed you are headline inflation. That's all encompassing. You can also look at core inflation. Now, core inflation sometimes gets a bad rep because it's looking at inflation, but removing out food and energy. And people say, why would you remove food and energy? Because households cannot live without food and energy. Well, the Federal Reserve is saying they get that, but these data points are volatile. And if they're trying to remove the noise, core can help them at least get a sense. Then you have to look at what goes into these reports. CPI came out yesterday. In the report, check out the sentence. The index for shelter was the largest contributor to the monthly all items increase, accounting for over 70%. Tim and I have talked about this in the past. In a weird way, it's important for shelter, for housing, for rent to slow because we represent such a high share of overall inflation, but also the data's lagging. When you look at shelter as it relates to inflation, it takes usually 6 to 12 months for the slowdown that we've seen in the housing market to actually show up in inflation. This can make inflation look higher than what's actually happening on the ground. The good news is, I'm not the only one who knows that. Federal Reserve knows that as well. And so they're cutting out the data and they're looking at what's called super core inflation. We weren't talking about this in the past, but this is services inflation minus energy, which we said is volatile, and minus housing, which we know is lagging. If you remove that, we talked about 5 to 6% inflation from those other measures. Super core is actually a little bit below 4% today. Still double what the Fed wants, but in a more reasonable range. But if you step back, what this inflation data is telling the Federal Reserve is to keep pumping the brakes. The economy is still operating too hot. Having inflation that is too hot in the economy is bad, bad, bad. Especially when you look at how inflation is spread out. We know from the most recent data, we still have 90% of all of the major inflation groups that are performing above the Fed's target. On the right-hand side of this right chart, transportation, medical care, education, and communication within reason of what the Fed wants, but different story for apparel, recreation, other goods and services, housing, and food and beverage. So again, go back to last week, but let's go back to the earlier part of last week where Jay Powell met with our lawmakers and he basically said, economic data is stronger than expected. We are not seeing enough slowdown in the broader economy. And so we're going to have to be more forceful to slow growth. Think about what's happened. We've had 8 short-term rate increases, 3 of which were just getting us back to pre-pandemic levels, 4 of which were just getting us back to where we were in 2019. That wasn't restrictive in 2019. That's just kind of a healthy economy that's moving along. So we have 4 of the short-term rate increases that the Fed has done that are just normalizing out the economy. We have 4 that are actually acting as restrictive, trying to slow growth. In February, we saw the Federal Reserve slow down, not as much of a rate increase. Going into last Friday, our expectation, the banks and investors' expectation, really the Federal Reserve's expectation, was that we were going to see a 50 basis point increase later this month from the Federal Reserve, really trying to slow growth. And then this happened. So I want to add the caveat. We are going to give a very simplified explanation of what happened, and we are absolutely not banking experts, but there are some pretty big things that are changing. At this point, I'm sure most all of us feel like we're somewhat experts in SVB, Silicon Valley Bank. So remember, they were the 16th largest bank in the US, second largest bank failure in US history behind Washington Mutual in 2008. Now think about SVB. They were pretty heavily concentrated in the very rapidly growing tech sector, and they had the deposits in their bank that they wanted to invest out. Very normal practice. They invested in a lot of hold to maturity, long duration government bonds. Now they did this understanding it would have a modest return, but government bonds are generally that safe return that you'll get. They didn't have that much diversification in their portfolio. And a natural thing that happens is that bonds have an inverse relationship with price. Fed has been raising short-term interest rates. That's making the bonds worth less. Now, they were sitting on unrealized losses, which weren't necessarily going to be a problem, or at least not as big of a problem, had there not been their depositors trying to take money out, and really some panic that sparked from Twitter conversations and from some WhatsApp conversations, where we had this classic run-on bank, where SVB had to sell their investments at just about the wrong time that ultimately led to the bank failure. Again, simplified version, but what we understand is this fear of, okay, wow, second largest bank failure. Is this an idiosyncratic issue or is this systemic? It's a really important question. So idiosyncratic, you could argue that it was. This SVB in particular, focused more on the tech sector, had that confidence concern because of social media and because of texts, had very little diversification in their portfolio. You can absolutely point some blame to just some bad decision making. But there are some market-wide concerns about the idea that interest rates are higher and government bonds are a safe investment. So we know that, not to the same extent, but other banks, other regional banks in particular, would have a similar holding. What happened was it'd be great to be able to dissect this and really get down to the nitty-gritty, but that's not what the Federal Reserve could do. Remember, one of their key general functions is to maintain financial stability. And what the Federal Reserve, Treasury, and FDIC decided was that SVB and Signature Bank were systemic risks to the financial system. They needed to restore confidence in the US banking system. They decided all depositors, very important to say depositors, not investors, were made whole. It wasn't investors that made risky decisions that were rewarded. It was companies that invested in these banks because they believed in the US banking system that were made whole. Federal Reserve saying we need to restore confidence, we need to restore stability, and we'll do what we need to do to make sure that happens. Now, this part, I think it basically goes without saying, but bank failures tell the Federal Reserve it's probably time to pause on those short-term rate increases. So let's think about this now in the context of the housing market. We saw that because inflation was hotter than expected, because job growth was hotter than expected, mortgage rates were going up pretty fast going into SVB. We were getting pretty close to 7% interest rates. And mortgage rates would have likely gone higher on that strong jobs report, and a 50 basis point increase from the Fed would have almost been guaranteed. And yet, here we are, a completely different environment in just a few days' time. 10-year Treasury has dropped. You can see 3.4. I pulled this morning. 10-year Treasury is down on SVB. And more importantly, investors are looking for, again, that safe place to plant their money. They're putting it in the government bond. That's pushing yields down. That's pushing mortgage rates down. As we see what the Federal Reserve's next step should be, issue is inflation still too hot, still dangerously too hot, but financial stability may be more powerful, to the tune that the Fed may pause entirely later this month, or they may only do a 25 basis point increase. So really kind of wild backdrop to take us into the discussion about the housing market. And what I want to acknowledge is the data that Tim and I will present today is through February. We do not have stats right now through March. So this was really the world leading up to the changes that we've seen. And what we knew is that the spring selling season was off to a pretty healthy start. We've asked this question before and showed the responses before about how consumers were responding to rates in the 6s versus the 7s. End of last year, only 20% of builders said any kind of positive response. January and February, that got up to over 50%. Now, as we went through the comments, the builders were saying, well, yeah, there's a positive response, but we had to meet consumers where they wanted to be. We had to do some kind of change, whether to price or to interest rate, to drive some of the interest. So if you look at the existing home market, sales still down month over month, still down year over year. And then you look at Zonda's data. We track new home sales. Yeah, we see sales are down about 24% compared to last year, up 14% month over month. Track out that chart, really strong rebound. Because what right now we understand is that builders offer a unique proposition. Think about an existing homeowner who has sentimental value in their home. We raised our kids here. They maybe have some ego related to the purchase. My neighbor sold at this price. I don't want to sell for lower than that. My Zestimate says my home is worth this. Each of these factors are playing into the resale seller's mindset, where builders don't have that. Builders, in many cases, through the third and fourth quarter of last year, found the market. They found the market by offering those incentives, by offering the price cuts, some combination. What we know from our data at Zonda is 62% of builders have been willing and able to buy down a 30-year fixed rate mortgage to the mid-4s to the low 5s. What we know is 51% of builders have lowered prices compared to last year to the tune of 5 to 20%. An additional 15% lowering the prices by 1 to 5%. Why this becomes important is you've heard Tim and I talk about in the past, fear of buying at the top. For consumer that's shopping and they can see that they can get a home today for 10% lower than where it was, and the builder's either willing to help with the buy down or the closing cost, that's really helping set the mindset of, okay, there are some deals that are out there and I'm no longer buying at just about the wrong time in the market. Now, we wanted to add some math behind this, and Nick Schoolis ran these numbers. And so we went through each of the markets and we said, okay, base rate of 6.3%. If we want to get that payment in line with where it was in the spring selling season of last year, what would we need to do? Now, we picked spring selling season because before mortgage rates rose, we know that the market was off to a strong start last year as well. We know not everyone is payment driven, but a lot of buyers are payment driven. And so we ran this by market. And what we found was, in general, a 20% price cut was what was needed to get back to the payment at that early 2022 levels. Now, luckily, mortgage rates are moving back away from 7% because once we were getting close to 7%, that was a 25 to 30% drop in price to get us back to spring selling season of 2022. Now, what we understand is that cutting prices isn't always the smartest thing to do. So we said, okay, what if we don't do as dramatic of a price cut, but let's throw in the combination of a little bit of financing, a little bit of change in price. What we found was a different story. A 5 in some markets, a 10 in others % price cut combined with a 5% mortgage rate buy down does the same thing as a 20 or in some cases 30% price cut. We're seeing that builders have been willing and able to do that, and we've seen that direct response from consumers. Now, as we look at pricing, this is a very dynamic topic where, as we were in February, about 56% of builders held their prices flat. And then we had an equal mix of builders that lowered prices and raised prices. As we were looking at the builders that raised prices, it made me a little bit nervous because, again, I'm looking at it from an economist point of view, not from a home building point of view, where we're trying to get inflation under control. What made me feel better was looking at what we presented at the beginning of last year, where 90% of builders were raising prices. When we look, though, at this shift, because really at the end of last year, most builders' prices flat or down, not going up. This year, we asked ourselves the question of why would we see prices going up? Well, part of it is supply and demand. Resale inventory is up a little bit, but still extremely constrained compared to pre-pandemic. You'll see that in the next section. And as we talked about last time, builders are in that unique place where they're making up about 30% of the market. Builders are able to meet the buyers where they are. The second part is the idea of builders finding the market, ripping the Band-Aid off, knowing that's an art, that's not a science. So we've talked to a lot of builders that lowered prices to the tune of 10, 20%. A lot of consumers returned, and now they're raising prices to try to temper that level of growth. A very interesting change from when we met at the end of last year was that 80%, just about 80% of builders in December expected that prices would be lower this year compared to last year. Today, for February, it's now only 40% of builders that are expecting prices to be down. So we're seeing the sentiment shift on the ground. We see this in the NEHB's housing market index as well. But as we track this out, we say, okay, well, why is traffic up? Part of it is seasonality. First quarter should be stronger than fourth quarter. Part of it is the acceptance. Think about how many people put their life on hold because interest rates doubled. And now they're saying, you know what? I'm still expecting a child. I'm still looking to move. I'm still relocating. And you know what? This is what the market is. People coming to terms with the discounts, finding those deals and feeling more comfortable with the market. And I think an underappreciated part of what's happening is pent-up demand. How much of this increase in activity to begin this year are people that would have bought in the third and fourth quarter, didn't, and now they're returning to the market. As we talk to builders, they say the top 3 would be consumers getting comfortable with rates in the 6s, consumers responding favorably to the discounts and deals, and pent-up demand. As we tracked out sales volume in February, it was most builders were saying that it was stronger than January, but in real time, we were tracking how the market was shifting. We had a sizable amount of builders that were saying the month started strong, and then interest rates went towards 7%, and then the market demand slowed. So we're in a tricky environment now where rates have come down, but economic uncertainty has gone up and gone up pretty quickly. Ultimately, though, what we're seeing is traffic and sales are below where they were last year for most markets, and you'll see that in the next section, but definitely seeing more signs of life, which is where I want to go here for the last 8 minutes of my section. Go through regional differences. We have done this before. I want to do it again because it was pretty well received since we were able to show so much data in such a short period of time. These stats are updated through the beginning of this year. Last time we did this was September. I'll provide a little bit of context of how the market looks different from then till now. We'll start in the Pacific region, head over to the Northeast. First line of each table will be the sales rate change compared to last year. Remember, I told you, basically everywhere is showing that sales are down on a year-over-year basis, at least for the metro. You'll find unique communities, unique builders where that's not true. But you can look at the sales rate change from 2019 as the second row. We like this as a more stable, healthy year for the market. So as you track out sales rate change year over year in the Pacific region, most outsized drop in San Francisco and Sacramento. These are a couple of the markets that do have more of an outsized impact to some of the tech layoffs, white collar layoffs, relocation, SVB, startups, you name it, we're seeing a little bit more exposure here. Now, as you track out San Francisco, we can see that QMIs are down from 2019, total units under construction down notably year over year, resale inventory down notably. We think for these markets, there's, in San Francisco in particular, very little risk of any kind of oversupply, though the market is absolutely adjusting in real time. Across the regions and across the markets, San Francisco leads the way for the biggest change from peak pricing, down 30%. If you look at those total units under construction, we have two metros that are standing out for seeing growth year over year, Riverside and Sacramento, also seeing existence of QMIs. Now, I want to say this now before I forget. In the third and fourth quarter of last year, QMIs were kind of a liability. Demand had slowed so much, QMI was building up. Now it really depends on where are those QMIs, how are they priced. We know that some consumers are actively looking for a QMI right now, something they can move in, something that they can lock their rate. So know that it will depend, but seeing 143% change in Sacramento, we're definitely tracking that. Now, as you look at this existence of higher inventory, we then layer in incentives. You're seeing a higher use of incentives in these markets, I think partly because of the supply and demand dynamic. But take a look at a market like San Diego. San Diego outperforming all of the other markets in the Pacific region with that change from 2019, where nearly all of the communities are offering incentives. I think an important thing to think about as we go through this is not all of the sales are organic. Some of these sales are driven by the changes that are available to the consumers. Across Pacific region, though, all of these markets are seeing at least where we were through the beginning of this year, prices down compared to peak. Molly Carmichael does a lot of work in the Pacific region, and she was talking about how price cuts, particularly and really led by the publics, have helped reignite demand. Then you go to the Rocky Mountain region. Across these top markets that we're showing, we're seeing overall sales rate down both year over year and compared to where we were in 2019, with a little bit more inventory coming online, at least compared to what we saw in the Pacific region. We're finding that overall prices are down from peak, but track out a market like Denver. I would think if we rebrand this data in a month or two, it'll be a little bit more than down just 1%. But what we found is the cancellation rate got so high in Denver that there was some reluctance to lower prices too much, more use and heavier use of incentives. So we're finding most of the communities that we're tracking in Denver are still offering some kind of incentive. Our biggest thing that we're looking at in the Rocky Mountain region, and we've shown this in the past, is just that those payment to incomes are so out of whack. And as Tim and I were talking about this, Tim was really saying that the closer we can align prices to the area median income, the more we will sell. And I think that's the biggest constraint as we look at somewhere like Rocky Mountain. A notable change from September is if you look at Salt Lake City and you look at the 2% change in quick move-ins, in September of last year, that was up 110%. So again, showing kind of that real time that consumers are responding to the adjustments made on the ground. If you look at the Southwest has been interesting, in particular comparing it to September. In September, the markets that we showed for the Southwest region were all notably and pretty strongly down compared to 2019. The data that we pulled now, Brian Glasshagel being one of our experts, Keith Hughes, Dustin Mowdy, as we talk to them on the ground, what we're hearing is that there is some stronger activity right now in Texas compared to where we're coming from. Now, as you track out the builders being able to gain some share, you're definitely seeing still that constraint on the resale side that isn't as prevalent in places like Phoenix and Austin, where depending on the source that you're looking at, inventory is a little bit above or a little bit below 2019. But this looks a lot different than many of the other markets where you're actually within striking range of that 2019 inventory level. Again, QMI doesn't necessarily have to be bad. It just depends on where it is and what kind of shoppers are out there and how much is out there. But you can see a higher level of QMIs in Austin and Phoenix and San Antonio, with more units under construction. I think our big takeaway as we look at the Southwest region is, while Tim will talk about starts turning a corner a little bit in some parts of the market to start the year, we think we will continue to see some slower starts in this region until we work through some of the pipeline. Now, remember Phoenix, this was one of the hardest hit markets across the country. Tim, myself, Stephen Hensley, he's our Arizona expert. We were in Arizona recently for our Dealmakers event. And Stephen's talking to builders on a regular basis, working with builders and developers and touring communities. Stephen's definitely noticing that there's a lot more cautious optimism for one of the markets that was hit the hardest. Definitely seeing more activity, definitely seeing more signs of life. Moving on to the Midwest, we have 3 more regions before I pass this to Tim. Mixed bag. Again, when you look at the sales rate compared to 2019, with higher levels of inventory right now in Cincinnati, Columbus, and Minneapolis. But what really stands out to me, and this is a very short, quick hit on my hometown of the Midwest, or I guess home region, the big thing is, what other options do consumers have? I think when you look at the higher levels of QMI in the Midwest, this is actually a good thing for the builders, because if you look at resale inventory across every region in the country, we're seeing down 50 to 60%. Remember, some markets are basically in line with 2019, not seeing that in the Midwest. I think this is a really big opportunity for the builders right now. Then you move to the Southeast. Now, a difference again compared to when we presented this in September was in this top line in September, that sales rate year over year change. We had some markets that were up compared to last year. We had some markets that were down. This time around, what we see is all of the markets are down compared to last year, but Charlotte, Miami, Nashville, Raleigh, these are barely down. All of these markets, again, this makes it a bit of an exception to some of the other regions, are up compared to 2019. But think back to what I said about San Diego. It's not all organic sales. We know there's job growth. We know there's migration, but we also know there's sensitivity to price and timing the market. So some of these sales are driven by a little bit of adjustment in price and the use of incentives. Now that's changing a little bit in real time. We're finding that Christine Smales, one of our experts in the Southeast, she's saying that she's seeing more price increases and fewer incentives, but they're still available in the market. Jacksonville, Louisville, these stand out for the highest level of QMI. When I talked to Christine Smale, again, our Florida expert, about Jacksonville, she was saying that a lot of the QMIs are concentrated in the more affordable drive until you qualify areas. Ultimately, in the Southeast, for a very short period of time, a little bit of a concern about the buildup of inventory, but Christine says a lot of that has been worked through. Final section here, Northeast. Northeast sales rate, very similar to the last region, we're seeing up compared to where we were in 2019. This, to me, is the biggest part of the discussion. QMIs, either up to down, but modestly. Total units under construction, very small in terms of total volume amount. Resale inventory down 50%. What we're finding is the lack of any kind of construction and new building and the lack of resale inventory is the primary issue. That's what Dan Fulton is talking about as our Northeast expert. And what Dan's basically saying is that's allowing for more price stability. It's allowing for a better average sales rate per builder. But if you look at total sales, those numbers are down just based on pure volume. My final slide here, I've heard a lot of optimism and I would say borderline irrational exuberance about how housing is back for good and everything is great and we worked through the slowdown and now we're back in growth mode. And I think what we all need to have a little bit of humility about how things are changing so much in real time. We've talked in length about Fed policy and how there's been a pretty good chance of an error. We've said before, it takes time for Fed policy to show up in the economy, for changes in the economy to show up in data. We're seeing that play out in real time. We talked last time about consumer spending, represents 70% of the economy, lower saving levels, higher debt levels, and then the office market. Jeff Myers has led the charge on us talking about, hey, office market poses a risk. We've said it for years and we haven't seen it fully come about because we understood lease times of the office market are tricky, but we are starting to see a little bit of signs of that cracking as well. With that, Tim, I'm 6 seconds over, so I feel like I'm pretty good about that. Let me reintroduce Tim Sullivan to everyone on this call. Tim is our Senior Managing Principal of Advisory. Tim oversees all of our custom market study research. Tim talked about how some of that research is evolving as the housing market evolves, but some of our bread and butters include the feasibility studies, master plan community research, and land and lot supply analysis. Now, for those of you that don't know Tim, I think one of the most important things to understand is his obsessiveness in understanding what's going on. I've talked in the past about how Tim's a connector in our industry and sharing insights and gaining insights. But beyond that, Tim is an avid researcher and reader, looking at different trends, different pieces of data, looking at it from different angles, and then sharing out what he's learned to both our team and to our clients. Tim, it's really your obsessiveness that helps make us better overall. So let me pass it to you.
Ali, thank you very much. I appreciate that greatly. And I want to rephrase a couple things you said. And I've got one question that came from my friend David. And so you can think about it ahead of time. It has to do with sales reflecting sales prices, or are they adjusted for incentives? Because his question is really, is the industry shooting itself in the foot by propping up sales prices while giving incentives instead of lowering prices? So think that through. But Ali, you said the disconnect between the government and private sector sources is important for us to pay attention to. And ladies and gentlemen, if you pay attention to where the job base has really expanded, most recently it's been in services and also in leisure and hospitality. Ali, the super core reference you made, I think we just call it service inflation rather than super core, because it's services minus energy and housing. So, I mean, it's really the service side. And I really wasn't that familiar with supercore, so thank you for that. And that statement about bank failures, probably time to pause interest rate increases, given what's happened. Just from your standpoint, if you were to guess one way or the other, do you think we're going to have a 25 basis point increase in the Fed funds rate, or do you think the Fed will actually stand pat? What's your guess? Notice I said guess.
Yeah, I could be wrong. I think they should pause. I think they will probably pause.
I am hopeful, but I'm guessing the 25 basis point increase. Let's see which one of us is right. Now let's go back to David's question, regarding shelter inflation. Does the data reflect sales prices, or does it adjust for incentives? And his point is simply, we might be showing higher prices than actually are occurring. What's your read on that so far?
I believe it would be sales price. Well, if you're looking at inflation specifically, it's not even looking at pricing. It's looking at owner's equivalent rent. So it's looking at rent and owner's equivalent. So if someone could rent out their home, what would they rent it for? I think the idea of shooting yourself in the foot is something we actually talked about at South by Southwest this week, which is the increase we've seen in sales right now is because of this reactionary drop in price and increase in incentives. But the question is really, how sustainable is that versus making some broader market changes to product, to location, all of these different factors to help drive a more sustainable path of growth. But inflation, it's not going to be based on prices. It won't include incentives. It's nothing like that. It's rent and owner's equivalent rent.
Thank you for that, Ali. And David, we can talk offline about that too. Ali, thank you. And what you ended with is what I want to start with, and it's the concept of humility. And the market's uneven. And notice we have bifurcation here twice, because the public and private builders have behaved a little bit differently. And we've also seen the entry level and luxury market has behaved a little bit differently. Now, with the luxury market, of course, that you've got a buyer that can buy when they want, because they're typically discretionary. But there's just these levers that are being pulled. And even in the for rent communities, we had a meeting yesterday with our whole team, and Christine Smale, who you heard that she's based in our Florida operation and works in the Southeast. As she is wont to do, she went above and beyond and started interviewing some of our clients about this and came up with an interesting perspective, which is when you're looking at the single family rental side for a builder or owner, they typically want to get out in 12 months. So right now there's maybe a leverage point where if it's single family, 80 units probably fits pretty well. If it's townhome, it's 120 units. But we've seen 7 or 8 projects just yesterday when we were talking about it that flip-flop from for rent to build for sale rather than the opposite, which we were seeing a year ago. So keep an eye on that. And of course, one other thing to think about, the last bullet point there, resale inventory is so low. We're now seeing 30% of total transactions be new homes, which is a massive opportunity for the new home side of the world, where conventionally that number is 10, 12, 13%. So let's strike while the iron's hot. Now, this first element is ultimately asking the question about how demand is shaping up. Look at the blue bars for February. Now, note this is end of February. There's been 2 weeks since then, and things are moving. But right now, it's generally positive. The standpoint is that the builders are saying, the January strength is moving into February. Our sales plans are pretty close to what we want. So the takeaway is simply that there is some positivity related to demand. We're going to watch that on a daily basis, so stay tuned. And as we think about the ultimate challenge with an operation, look at that left-hand side, the blue 67%. It's hesitancy. That's why I relate it to Ali's statement about humility, because there's so much uncertainty out there. And with SVB, we're monitoring this because for many people, that $250,000 deposit is their down payment. So now that they know that it's safe, maybe we can settle in, but holy cow, that certainly threw a little bit into the market. Now, Ali had said not every buyer is payment driven, but when we're talking about the lower third sales rate, meaning the lower third price, it's very important. And what I'm about to show you are the three tranches, lower third, middle third, and upper third of the marketplace and how absorption rates have changed from 2019 to current. Now, notice the dotted line is the average right now. And look at the vertical axis, because that's going to change on the three that I show you. But as you look at here, look at Tampa and San Antonio. Compared to 2019, these markets for the lower third pricing are outpacing. Now, as we move to the middle third, it's a little bit different story. However, look at Charlotte and Tampa. They're outpacing. Now, notice here, the average is about 1.8 sales per month as an average. I'm going back to the lower third. That one's more like 2.4. So you see that, as prices go up, there's price elasticity. Prices go up, absorption goes down. But let's look at the highest part. This is the highest third pricing point. Once again, look at Raleigh, how it's outpacing. And I want to give a shout out to a builder that I'm very familiar with in Raleigh, Roebuck Homes. It's a third generation builder. And they've seen their product evolve and the demand in the high end expand. And keep in mind, this is Raleigh, which is a pretty well diversified market, but also a lot of great job base. Now, you might find this a little bit surprising, but when it comes to all cash buyers, look at some of the smaller towns, because we are going to have some small town love in just a little bit, to highlight some of the smaller markets. But look at these markets and look at the percentage buyers that are cash. Now, the national average is about 13. But look at Naples, 54, close to 55%. Look at Hermosa Springs, Florida. I mean, that's 52%. Now, you think, why is this happening? Well, pay attention to the reload buyer and also pay attention to the active adult or the move down buyer or the baby chaser. Moving from a larger market to a smaller market, that element is opportune. And it's fascinating. You heard what Ali was saying about the Midwest being a bit of a mixed bag and what other options do they have? Well, once again, think about the factors of a move down or a reload buyer. And look at my hometown of Kansas City, third from the left. I mean, this is pretty significant. This is larger populations, over 1 million, and look at the percent cash buyers. These are all above the national average. Fascinating stuff. But as you think about cash, what about financing? We were a little surprised over this last year that we didn't see a bigger comeback with ARMs. And with interest rates popping up and with the flexibility of an ARM, you can always refi the next year. We haven't seen that. If anything, we've seen kind of an erosion over this last couple of months. And we attribute that to the hopefulness of interest rates starting to move back down. We'll keep our eyes on this one, but holy cow, it didn't quite move the direction that we had originally anticipated. Now, a little bit about supply. And we're very, very happy to report from the files of as it should be. Look at most markets and how they've responded to this slowdown. Well, they're pulling back starts. And look at this up and down, left and right. 2 markets in Florida are the only ones where we've seen a slight increase, Central Florida, and then of course, Sarasota, Bradenton. Now, this is as it should be. And this to me reflects that we've got a pretty healthy line on the way the market is going. And conversely, when we look at what's happened to starts, this left-hand side of the graphic is something that we were showing during COVID all the time. And it's government services, labor, supply, land. Where's the disruption? Draw a little visual line on that 3/1/2022 and look at the downward motion that you've seen. Now, there's been a small tick up in labor, but for the most part, over this last year, this has moved in the right direction. And then when we start asking questions to builders about the actual material cost, 81% are saying that in some way, shape, or form, there's a significant, moderate, or at least some level of improvement. However, there's a difference between the front end and back end trades, and that continues. We'll continue to monitor it, let you know how we see it and how the builders are reporting. But this realignment is good news. And notice that 55% of builders now expect starts down this year. Just go back a couple months ago, that was 75. So say it a different way. There's a little bit more optimism about getting to the point where we are at or pretty close to the expectation of our business plans for 2023. And look at that pretty much right in the middle, the roughly as the same as 2022, pretty significant change just in this last year. I'll pause here for a second. We have conversations with a wide variety of public sector and private sector groups about what supply should be in individual markets and MSAs and nationwide. And I think depending on the way we make assumptions, if we look at for sale, if we look at rental, we can make a case that we're undersupplied by 1 million units or even 4 million units. But let's flip the script. Let's just look at it from a ratio and think about the number of starts per 1,000 people, and this is in the US, and use your little visual lines and look at the 60s, 70s, 80s, 90s, 2000s. And note that we're at about 3 starts per 1,000 people. Now, the historical average is 4, but holy cow, look at the 70s and even parts of the 80s. They were way above where we are now. And you can see that trough that occurred, and rightfully so, after the big movement in the early 2000s. But this gives you another perspective that that supply issue is real. And speaking of markets that are having more difficulty, look at the starts per 1,000 for these markets. I mean, this is LA, Dallas, Columbus, and Orlando. You know, generally, when you look at the LA market, you can see that it's way, way below because it's been held back by land use regulations, NIMBYism, and the cost to develop. As we move forward, think about a couple of the level of starts does vary by market. And look at those numbers at the very top, Raleigh. You know, we've got a market that has economic and demographic shifts that probably justify that pretty well. Austin's moved a little bit fast, but drop all the way to the bottom. Look at LA again. This is a market that simply can't supply itself. Very, very difficult to bring product to that market. Now, in many markets, we've got new supply on the way, and this is another part of an important conversation that we're tracking closely. Because when you think of QMIs, and Ali was talking about that by market, the quick move-ins, the standing inventory, that's one thing, but in most markets, I'm not concerned about QMIs. Now, this is the pig in the python that we're going to keep tracking. And note that there's a number of markets that have seen a doubling, you know, compared to 2019 to now, a product that's in the market. But that's okay. Ultimately, that's okay, depending on how fast this product comes to the market. And we ask the questions often about land prices because, you know, land prices, if we can get them a little bit lower, we probably see more transactions, and that translates into lower priced homes. But look at that 62% number. 62% of builders are responding that they're cautiously moving forward. And that's been pretty consistent. This cautious element has been pretty consistent during the time we've been doing the survey over the last, 6 months to 8 months. And with land prices, when we're asking which direction you're seeing, 67% are saying generally flat. And that ties very, very closely to the sticky concept. When we pull back then and think about the nationwide numbers, look at our new home lot supply index, the LSI, and go back to 2015, which really benchmark is kind of a balanced market. We got down to below 40. We're now pushing towards 50. We anticipate this may continue to move up a little bit, but we like to give that perspective, that historical perspective, because right now we're really back to early 2021 numbers. And as we look at this, and this is a night chart test, but when you look at this by market, the vast majority of markets are significantly undersupplied. Right now, Boise shows up as a slight oversupply, but not significantly. And you look at all the other markets, read to the very bottom with Miami, Nashville, these markets for at least lot supply, we're not seeing enough. Now, I had promised a little bit of small market love, and we'll go through this quickly, so keep those seatbelts fastened. But we just want to let you know there are some interesting things happening, not the least of which the economic situations in some of these markets prove out the tightness. You look at the unemployment rate by metro, with 3.5% being that dotted line. Holy cow. You've got markets like Columbus and Fort Collins and Charleston that have 3% unemployment rates. And as we look at the high incomes, now keep in mind, now we're talking about jobs and the job growth by market. This gives you another element of comfort that some of these markets are actually going to see a move-up market strengthen. And notice Charleston and Boulder and Port St. Lucie, and it's had a 10% increase in the high income payrolls since 2019. Now I'm going to go back to that lower, mid, and upper third. Now keep in mind, this time we're looking at a little bit different markets. It's not the massive markets, but this is the affordable side. And keep in mind that dotted line is the average sales rate, and we're comparing 2019 to current. And this is the more affordable side, so the price sensitive side. And notice that there's a couple of markets, look at Greeley and Charleston, that are performing better than they were in 2019. Now, keep in mind, watch that vertical axis, vertical axis, because it's a little bit different on the third slide. This one's very similar. We go from 0 to 4. Once again, Charleston, Port St. Lucie, moving better in that the middle third sales rates. Now let's look at the high end. Now, notice this sales rate. The average is about 1.4. But look at Port St. Lucie, Greeley, Colorado Springs, Sarasota, move to the right with Richmond and Fort Collins. These markets have moved better, and that ties to what we said in the very beginning of my section about the bifurcation of the market, that the upper tier in many of these markets is moving very well for economic reasons and for those reload reasons. And let's just look at housing starts for a section of these. Notice that they are moving in the right direction. Again, from the files of as it should be, these markets have responded appropriately to where we see demand. Now, active listings, this is kind of alarming. And while it might seem good because it means the home buyer will pay more attention to the new home market versus the resale market, the great news about this is simply that there's fewer product out there. Now, that becomes a problem because it's lesser supply, more upward pressure on pricing. So a couple of final thoughts here. And we'll start with the concept of good news. Now, this gentleman, 81-year-old gentleman, Jerry Jewett, was locked in his car for nearly a week on Highway 395 in California in a snowstorm. And he survived. And he survived because he had a bottle of water and a couple of munchies and a heck of a will to live. And I read about stuff like that, particularly for an older gentleman. That's pretty impressive. Now, another thing that is very interesting is Magnum Real Estate of New York has announced plans to build a 6-story building above a Costco, so 800 apartments above a Costco. And I bring this in for good news because I just think it's smart land use. And it's also going to be a whole lot easier for these people to carry all their boxes from Costco up the elevator. Now, not to be outdone, let's talk about our friend, the one and only Elon Musk. And Elon is planning a new master plan, a Texas utopia, as he calls it. And it's in Bastrop County. And my associate, Brian Glasshagel, and Kimberly Byram know a great deal about that marketplace. And the vision is to bring attainably priced housing to the people that work for his companies. Now, I just want Mr. Musk to know that I'm here to help, because while I love the concept of this, we've got to work on some of the marketing and the theming. He calls it Snailbrook. I'm not sure that's the most attractive name, but we'll talk to him offline about it. A couple of other things we want to bring to your attention. What a surprise. If you've got kids or young adult kids, and the concept of social media and how much time they spend, research shows time and again, reducing screen time improves mental health and self-esteem. What a concept. But I wanted to bring you from the annals of the Sullivan family, kind of a crazy offset to that. There's been research, and I'm sure it's a little self-serving, but there's been research that shows that crazy Dungeons and Dragons game, which has been around for 2 generations, increases the emotional skill set of children. And I'll tell you that one of my sons, for his 25th birthday, hosted one of these things. And while it seems like it's online, it was not. It was actually people together doing this, play acting, learning interpersonal skills, decision-making, team building. I just want to say, from a focus group of 1, it was an interesting take. And last but not least, these are my favorite. An 80-year-old man named Mr. James, who was a janitor, retired from this school in Texas. And turns out he didn't have enough money to pay rent. So he came back to work as an 80-year-old. And this young man that works or that goes to school here, last name of Tidwell, said, "No, that's not right. This gentleman's 80 years old. Let's get a GoFundMe and we'll try to get $10,000 so he can pay his rent for a number of years." Well, it caught on fire. It's now, as of the end of February, a $250,000 fund with over 8,000 donations. Love stories like that. And if you're wondering if the younger generation has the empathy and the skill set to succeed, all I do is point you to Mr. Tidwell. They absolutely do. Today, our inspiration, after I read about this gentleman, I wanted to share it with all of you, because this is a gentleman who was in the Vietnam War, was wounded once, and back then I believe he was a major, went to save a medic that had been shot, got wounded again, went to save a U.S. advisor who was presumed dead, got wounded again, and then ended up making sure everybody was taken off the battlefield before he left, after he was grievously wounded. Obviously, he survived. He was put up for the Medal of Honor, and somehow the Medal of Honor was lost, or that the application was lost. 58 years later, it finally was acknowledged. And I bring this up because this gentleman is one of only 4 human beings in the world that has won a Medal of Honor and a Soldier's Award. And a Soldier's Award is doing something that's not on the battlefield. And he saved some people on a Jeep wreck that had happened in Vietnam. This gentleman is pure inspiration. Thank you, Colonel Davis. Now, I want to say thank you to our Triad friends. You guys have been fantastic partners. Russ and Lowell, thank you very, very much. Please reach out, find out more about Triad if you're not already working with them. And Ellie and I want to thank you and also let you know you can subscribe to all the emails and the upcoming webinars and all that kind of good stuff. Just hit the UR code right there, the VR code, and you're there. Remember, this will be taped. You can get copies of the tape. Reach out to Amanda Prieto if you have any questions. Talk to Karen Bonder, as I mentioned earlier. And Allie and I send you on your way with good luck, everybody. We're going to keep tracking this market. We'll share what we find, and we appreciate working with you and your friendship. Take care, everybody. Thank you. Bye-bye.